Hey guys, Mike here. So obviously another interesting Friday to say the least, because the day was quad witching, and I believe I told the members I think it was $3.2 trillion in options expiring. So you knew it was going to be all over the place, hot mess, and that's exactly what happened. Tried to fight back at the end of the day, but it just did not happen. Not enough bulls to push it up. And again, obviously we got the Fed next week, so nobody wants to be holding anything over the weekend probably. And a few things we're going to go over today that's important. The first thing I'm going to talk about is the chart. And as you can see, one of the major things that happened was we broke down below that golden pocket, which is between 618 and 65 right there. And a lot of people were waiting that. It's a big psychological level. And that was big, because I think if you look closer here, we'll go to the 15-minute, and matter of fact, let's pull up the 5-minute. You can see at the end of the day, it really tried fighting its way back up to close the gap and get back up to that level. But of course, it failed. And you can see, it was almost a % move up in a very short amount of time, trying to push it up at the end of the day. And, going back over here, you can see the real reason why that level was so important. A lot of people were watching, and I think a lot of algorithms kicked in was because it goes back to May and June. As a matter of fact, it was support at one time, then it became resistance, and then we're looking at for support again. But also, one thing we also did was left behind another gap to fill coming up. So we got a few big gaps up top here to fill whenever the stock market decides to move back up. But that's really the big thing to look at on that. And if you sit here and understand, like I showed you before, we're only 5% from the June lows on the SPY. That's it. And S&P, that's nothing. And of course, one thing that drove the market down right out of the gates was FedEx. Gave disastrous basically news for their company. They lost a fifth of their market cap overnight, dropped by 20%. And remember, this ain't some high-flying tech company, right? It's FedEx. And pulled their guidance and cut it in half for the rest of the year. It was just a mess. And I want to see what their CEO says. I want you to hear from his mouth, what he thinks is going on. And this is from a global scale, because obviously they're a global company.
Asia is the center of manufacturing in the world.
Right.
So when you see these things happen, I feel it's leading indicator of something, more profound. The U.S. has been somewhat insulated because the U.S. dollar is the currency of choice for the world, and there's some insulation there. But I do see the U.S. is slowing down too.
And if you get anything out of this, please hit that like and subscribe button and share the video, because the channel is so close to 50,000 subscribers, and I appreciate all your support and comments down below, guys. Thank you so much. And so a company like FedEx, which is considered, a boring, quiet, dividend-paying company, because they had to raise their dividend, and usually when you do that, you think, oh, everything's good, and then to come out with that guidance, they're obviously seeing something, but again, we don't know if it's on just their company level and they're running their company badly, which, by the way, they'll be cutting back hours, closing 90 FedEx offices, that kind of stuff to cut costs now. And that's why I'm saying we got to look to UPS, right? Wait to hear UPS come out. Are they going to cut guidance or not? Or are they just a better ran company? So that's what we got to see. But, when a CEO like that says some things, I like to listen to get his perspective. We just got to get confirmation now that is the case. And I agree with him. We know it's a contracting economy here and around the globe. I've already kind of showed you that. And that's the reason why China is doing stimulus, right? You don't do stimulus unless you need it, right? Unless your economy is struggling. And then another guy ran across doing an interview, and he was talking about market sentiment and stuff, right? He was talking about the Fed and how much, I doubt they raise 1% next week. Some people are trying to float that out there. But, I think 75 basis points is cooked into the cake. It's safe. They don't like to shock the markets or anything, and so that's probably going to happen. But I've told you before what that means on a government level, how much more interest we pay. But there's one thing when he's talking about market sentiment, and if this happens, it will be disastrous for earnings, absolutely disastrous. And when he's talking about this, think about what you or people around you have talked about doing for the holidays.
We have $30 trillion of debt, the nation. The increase 1 point, if he goes 1 point on the next week, that's $300 billion of incremental interest expense. $300 billion is half of the defense budget of the United States. It's a lot of money. So the 2 or 3 rates he's done is almost $1 trillion of incremental interest expense. Now, not all our debt is floating, but significant portion. We do continue have to feed this deficit by issuing bonds, and it's at ever higher interest rates. The economy, if you look anywhere, is already slowing. And if you look at the signs, like I have a slide on consumer confidence, if they could put it up. Consumer confidence is terrible. And where will that show up? And it will show up at Christmas. At Christmas, if you survey the consumer, half of the people will spend less this year on goods than they did last year. 20% of people will spend 50% less than they did last year. And they're doing that against piling up inventories, which you can put up the next slide. And inventories are moving rapidly higher. Companies bought goods thinking the pandemic behavior would last forever, that we're going to buy everything on site.
And by the way, all that stuff said they're on the water or already here.
It's here.
Yeah.
It's here. It's in warehouses which are chock full. And you saw what Target did. They had the terrible quarter earnings where they had to clear the inventory. But this is just the beginning. The inventories are here. So you're going to see huge price sales of things that are in the CPI. And the CPI, the data they're looking at is old data. All they have to do is call Doug McMillan at Walmart, call any of the real estate fellows and ask what's happening to our apartment rents. I mean, the economy is breaking hard.
And again, I showed this yesterday, but that guy's in the real estate market, and he knows that's exactly what's happening. Stocks have been taken out the woodshed, cryptocurrency, and now real estate is starting to be taken out to the woodshed. And so the Grim Reaper is coming for it. And so I like that meme right there, as you can already see. And, we'll see. We'll see if that's the case. I don't know. Ask people around you, ask your family members, and that kind of stuff. And so, I mean, but people, if they cut back that much on costs, because the holidays are a big deal, right? I mean, we really depend on us going out there and just buying everything that moves and all that good stuff to bribe our kids and make them happy and blah, blah, blah. And so, we're going to have to see if that's the case. And if you see people cutting back on the holidays, oh, good Lord. What do you think that spells out for 2023 and the rest of that year? And so, and again, it feels like forever until the holidays get here, but we'll have to see. But the thing we really got to pay close attention to now, and this may take a little time, but we're going to see, is how the bond market reacts, how the stock market reacts to what's taking place right now. And that is the Federal Reserve, because remember, they're going to start doing QT, right? Rolling off that balance sheet. And understand, this is how crazy it's been, guys. They own a third of both the Treasury and mortgage-backed security markets. Let that sink in. A third. This is supposed to be a free market, by the way. And here the Treasury or the Fed has went and done this, right? I mean, that is insane amount of buying. And so 2 years of so-called quantitative easing doubled its central bank's balance sheet in $9 trillion, equivalent to roughly 40% of the nation's gross domestic product. By adding so much liquidity to the financial system, the Fed helped fuel significant gains in the stock, bond, and housing markets and other investment assets. Now, with inflation rampant, the Fed is unwinding this liquidity via a process known as quantitative tightening, or QT. In June, the central bank started shrinking its portfolio by letting up to $30 billion in treasuries and $17.5 billion in mortgage-backed securities, or MBS, roll off the balance sheet. That, by the way, did not happen. I showed you that. Or mature without investing the proceeds. The amount will double this month, effectively kicks in September 15th. And so supposedly you're supposed to have $95 billion roughly rolling off the balance sheet. I don't know how many of these actually expire to roll off, because as I've showed you, from June forward, we've done basically nothing. And so very little, to say the least. The market nobody's even talking about that. But if they start rolling this much and actually does start to roll off and start to pick up steam, then we get to see how the market really reacts. Because I forgot how much it is, but it's like, I don't know, what is it, for every 100 or 200 billion or something like that, it's like an extra percentage interest rate hike or something like that. I forgot what the number is. I told you guys a while back, but I forgot it now. But, so it's almost like still raising interest rates as well, but you should feel this immediately. Because understand, when they roll this off, like somebody has to pick up the slack there. Somebody has to be buying, right? Because they're not reinvesting. And it's a lot. And so that's what people are worried about. They're like, okay, is this, how's this going to affect the markets, right? If nobody's buying, and it's like anything else. I mean, you can't, and I don't care what you're selling, whether it's bonds, stocks, products, shoes, cars, whatever, somebody has to be there to buy that product, right? And so that's going to be the interesting part. I mean, that's, again, because remember, they were buying it, right? So that means everybody else got to put money into, whether it be stocks or cryptocurrencies or investing in other companies or research and development, whatever, right? So that money went somewhere else. Well, now it has to go to pick up the slack in this market. And so it's going to be interesting. Again, never done it in history like this, never, done it this fast. The Fed balance sheet's never been this big. And so it's going to be a very interesting experiment to see how this goes. And a lot of people are very nervous about it. And understand, like I showed you before, we're only 5% from the June lows on the SPY. That's it. And S&P, I mean, that's nothing, right? I mean, we dropped 4% in one day this week. So, that's something to look at. But again, I always say, and I'll tell you, I've been saying it for months and months at the beginning of the year, you're going to get plenty of opportunities to buy those stocks you love at cheap discounts. A lot of people are afraid they missed the bottom and all that stuff. And who knows, right? A lot of people think we're going back and visiting, but let's be real. Again, it's 5%. Till we get to the June lows, that's nothing. That's nothing, right? It's going to be, we can get there in one day if we wanted to, probably two. But, that's where we're at. And so we'll see what the market wants to do. Again, the Fed, everything's about the Fed meeting next week. I feel like it's going to be 75 basis points. Let me know what you think in the bottom. They're going to go 50. Are they going to go 1? You never know, but I don't see that happening. So, but that's where we're at and stuff. And, the funny thing is, you look yesterday, we had a, bad market, but there was like growth stocks, certain growth stocks, high growth stocks, right, were up. They were green, shockingly. I think Shopify was up yesterday, if I'm not mistaken. I think ARK was up yesterday too. And so stuff like that, you just look at it and you're like, well, okay then. That's interesting, isn't it? So again, a lot of stocks out there, these high growth stocks have been in that stage 1 for quite a while now, forming that bottom. And so, you see in the generals, like the big FANG stocks, they're starting to show a lot of weakness all of a sudden, right? And so, the generals might be getting taken out the back and shot in the head or something. And people might be shifting money over to the stocks that have been basing out. I don't know. We'll see. But let me know on the bottom, do you think we're visiting the June lows? And do you think we're going to break those lows? All right. So anyway, appreciate all your support. Hit the like and subscribe button, guys. And I hope you have a great weekend.